There's a number buried in the IMF's newest index: 12.7%. Not a target, not a guideline, a threshold. And crossing it doesn't just change strategy. It slashes annual FX defense budgets by 94%. This isn't guesswork and definitely not opinion. It's empirical observation, drawn from the IMF's 2026 Monetary Sovereignty Index, published just 6 weeks ago amid the worst quarterly FX swings since 2020. The index isn't theoretical. It's built on 12 years of COFR data, the IMF's official reserve database covering 37 emerging market central banks, and tested using regression analysis that controls for inflation, debt, and trade openness, so we know it's gold, not other factors, driving the effect. The data doesn't whisper, it shouts. Below 12.7% gold reserves, central banks intervened in foreign exchange markets an average of 4.8 times per year, defined as official FX purchases or sales exceeding $500 million in a single week. Above 12.7%? Less than once per year, just 0.7 times. That drop isn't gradual. It's sharply concentrated asterisk at that exact threshold. And it's not just about frequency, it's about cost. Because every intervention below 12.7% required borrowing dollars through BIS swap lines, emergency liquidity draws, or short-term credit, all carrying interest, fees, and forex risk. For the IMF's own fiscal impact model in working paper IFDP 1420, Table 4, crossing 12.7% cuts annual FX defense spending by 94%. Not by reducing volatility but by eliminating the asterisk need to finance interventions in the first place. Let's make that real with numbers on the table. In 2025, Indonesia at 11.2% spent $840 million defending the rupiah. When the currency fell 8% in March, it paid $112 million just to borrow the dollars to stop it. Vietnam at 13.1% spent just $52 million. Same region, same year, same volatility, different gold ratio, different P&L. That 12.7% isn't rounded. It's 12.68%, reported to the 100th, the resolution limit of the model. It's mechanical because gold requires no approval, no clearinghouse, no counterparty, no settlement delay. Just physical transfer and mutual trust. At that level, gold stops being a line item and becomes operational infrastructure. It processes stability. It replaces billions in dollar borrowing with ounces of physical metal. You're not watching theory. You're watching balance sheets reset precisely, measurably, irrevocably at 12.7%. And it slashes annual FX defense budgets by 94%. In the next chapter, we pull back the curtain on asterisk how those ounces do the work. So how does gold, a physical metal, replace billions in dollar borrowing? Not through symbolism. Not through sentiment. Through 3 precise, operational mechanisms, each one cutting a different cost line from the FX defense budget. First, credibility signaling. Gold reserves above 12.7% aren't just held there read as an observable, irreversible signal. Markets treat them as a hard commitment to monetary sovereignty. As the Federal Reserve's own IFDP 1420 paper states, gold serves as an exchange rate anchor and is used for exchange rate interventions. When investors see that threshold crossed, forward FX curves flatten immediately, a real-time gauge of devaluation panic, measured by 1-year USD, INR 90 delta put skew. That flattening means fewer hedging demands from exporters, less speculative positioning, and crucially fewer interventions before they happen. No trades executed, no dollars borrowed, no interest paid, just stability priced in. Second, bilateral gold swaps. This is where theory becomes transaction. Central banks don't need to borrow dollars from the Fed or the BIS. They swap gold, physically for local currency, with trusted partners who've also crossed 12.7%. Russia and India completed a 5-ton gold for rupees swap in Q4 2025, settled domestically, avoiding RBI's USD reserve drawdown entirely. China and Brazil did the same in September, collateralizing $320 million in liquidity, interest-free. No SWIFT, no correspondent bank, no OFAC exposure. Vault-to-vault transfer, settled in under 72 hours, meaning local currency disperses to the domestic banking system within minutes. That replaced what would have been $14.40 million in annualized interest at prevailing 5.75% USD Libra equivalent rates plus $2.10 million in swap fees and settlement overhead. Third, interest-free, jurisdiction-free liquidity. Unlike treasuries which require custody in New York and can be frozen, or SDRs which need 72-hour IMF board approval to deploy gold held domestically, is fully sovereign. It clears instantly. T+0, no counterparty risk, no clearinghouse delay, no maturity date, no coupon to pay. Unlike bonds, it's not an asset on the balance sheet, it's liquidity built into the balance sheet's architecture. So these aren't parallel options, they're interlocking gears. Credibility reduces the asterisk need for intervention. Swaps fulfill the asterisk residual need fast and cheap. Sovereign liquidity guarantees execution speed asterisk when it matters most. Gold doesn't just sit there. It processes stability. It replaces borrowing with collateralized, sovereign liquidity. It turns ounces into operational leverage. And that's why crossing 12.7% doesn't just change strategy, it collapses the cost structure. Because when you stop borrowing dollars to defend your currency, you stop paying for the privilege. So if gold above 12.7% replaces dollar borrowing, how much does it actually save? Not in theory. In dollars. On balance sheets. The IMF measured it precisely. In 2025, the 19 central banks below 12.7% spent an average of $2.1 billion each year on FX defense. That's not a projection. It's audited line item spending pulled from central bank financial statements and cross-checked against BIS swap utilization reports. That $2.1 billion covered three things. $1.3 billion in USD Libra-linked interest on borrowed dollars, $420 million in bilateral swap fees and collateral management, and $380 million in emergency liquidity drawdown penalties triggered when reserves fell below critical thresholds during volatility spikes. Above 12.7%, the cohort of 18 central banks spent just $137 million on average for the same year. That's not rounding. It's $137 million, a 94% reduction. And it's not from lower volatility. BIS data confirms identical down to the decimal quarterly standard deviation in exchange rate moves across both groups in 2025. Same US rate hikes, same commodity swings, same capital flight waves. The difference is structural, not cyclical. That $137 million isn't savings. It's operational overhead, vault security, gold verification, regulatory audits, the quiet work of keeping reserves battle-ready. Not crisis insurance but foundational infrastructure. Vietnam spent $52 million in 2025 at 13.1% gold. Indonesia, at 11.2%, spent $840 million under the exact same regional pressures, the exact same global shocks, and the exact same line item category in its annual report. FX intervention finance costs. Same region, same currency regime, same volatility, different gold ratio, different P&L. This isn't abstract. It's line item accounting. And crossing 12.7% collapses that line item instantly, predictably, and without discretion. Because gold doesn't reduce the asterisk risk of intervention, it eliminates the asterisk financing requirement. Full stop. No borrowed dollars, no interest, no counterparty, no clearinghouse, no settlement delay, just physical metal deployed as sovereign liquidity. That $2.1 billion isn't vanishing, it's being redirected now asterisk. As we speak, toward tools that strengthen domestic monetary control, local currency swap lines, gold-backed trade financing, and sovereign liquidity buffers. 94% isn't a discount. It's gold acting as a force multiplier measured in ounces, booked in dollars, and visible on page 42 of every annual report. Cutting intervention expenses by 94% not by chance, but by mechanical design. That $137 million overhead? It's not the end of the story, it's the floor. What rises above it is where sovereign monetary execution gets built. And the next wave of reallocation begins in Q2 2026, not as forecast, but as function. India added 12 tons of gold in Q4 2025, pushing its official gold reserve ratio from 11.4% to 11.9%. At its current pace of 2.5 tons per quarter, it crosses 12.7% in June 2026. When it does, its $1.80 billion annual FX intervention finance costs line item is replaced not reduced by two fully activated instruments. The Reserve Bank of India's Standing Deposit Facility, expanding capacity from 500 rupees billion to 1 rupee and 20 paise trillion. In India's Exim Bank rupee-denominated letter of credit facility, rolling out to 120-plus strategic importers by July 2026. This activates automatically under Section 17(2) of the RBI Act. No new legislation required. Poland stands at 12.3%, just 0.4 percentage points below the threshold. Its January 2026 Operating Framework Update embedded Rule Section 3.2(b), any gold purchase exceeding 500 kilograms, triggers automatic recalibration of its FX intervention budget. Poland's next acquisition scheduled for April will activate that rule, reassigning its $1.10 billion borrowing allocation to 12-month zloty swap lines with the Czech National Bank, strengthening local currency trade liquidity without touching USD reserves. This transfer is hard-coded into the central bank's ERP system and requires no parliamentary appropriation. Turkey sits at 11.6%, also within 0.4 points. Its December 2025 Financial Stability Report confirmed that gold reserve thresholds now govern budget execution binding on all quarterly expenditure plans per Article 7.4 of the 2026 Central Bank Amendment Act. The next purchase even 200 kilograms triggers reallocation of its $940 million FX defense line item toward lira liquidity facilities for SME exporters, providing first loss protection on lira export loans up to 36 months. No discretion, no committee, just code in the operating rules. India, Poland, Turkey, 3 sovereigns, 3 balance sheets, 3 timelines, all converging on the same mechanical inflection. Where ounces stop being assets and start being levers. Cutting intervention expenses by 94% not by chance, but by mechanical design.